Hey folks, Dan Frio here, the rate update, TGIF. It is Friday, the last working day for us of July of 2021. We come back, I'm gonna go over the crazy real estate market. Would I be a buyer in today's market? You might be surprised. And then we're also gonna go over the economic news for next week and what my anticipation is for what rates are gonna do. So don't go away, that's what we're gonna cover next. Okay, so would I buy a house in today's real estate market? Watch this video, and this is changing my mind a little bit. So we're going to talk about that next. So
the scene in Raleigh for years, knowing about how hot the market is, but it's really at a fever pitch lately. You've had, maybe we'll start with you. Actually, your listing is a good example here of a home you listed at, about $725,000. It sold for $801,000, and you even had one offer at full price sight unseen that you turned down. Why would you turn that down?
Well, it was just such a rare product. What I can say is it's more important now than ever to price things right in line with the comps, and we did. But we knew how many phone calls that we needed to take it to the market, and we ended up having 11 offers on it. So at the 725 price point, I think it's tremendous for 11 buyers to compete for that opportunity, and one to crest the 800,000 number. And they're the ones that got it.
So it's very interesting. This is taking place in my town, by the way, and in many towns across the country, where you price it down at where comps were or a little low in the hopes of getting multiple bids on it. I'm curious, how many of the buyers are coming willing to pay full cash or put down massive cash down payments? And where is all that cash coming from?
So we are a due diligence state. We have been since 2011. And as part of the offer, the buyer writes a non-refundable check directly to the seller as part of the offer. And what I saw on the low end with that one was 30,000, 40,000. And we ended up getting closer to like 75,000. So that buyer was willing to say, here is $75,000 that are non-refundable money. This is how bad we want this opportunity. So it gave, my seller a warm and fuzzy that these people will show up at the closing table.
Trying to wrap my head around those dynamics.
Yeah. When we became a due diligence state in January 2011, we didn't know what to do. We were putting $50, $100, even 4 years ago. I'd say 2,000 to 3,000 was a ton of money.
Wow.
In 2020 and 2021, I feel like 20,000 is about the bare minimum that a seller takes seriously if they have a good home.
And so that's what you would call your earnest money, putting it forward that you will follow through on the deal.
So difference between earnest money and due diligence. Earnest money is held in an attorney's trust account. Diligence money is a check written directly to Mr. or Mrs. Seller. That check, it is in their hands the day of execution, so it's theirs. The way that the contract reads is that the buyer may terminate for any reason or no reason. So that hefty sum is what I call it. It's like, that's what, they've got skin in the game right from day one. They're coming in with this non-refundable number, and that says, all right, that buyer is going to close on this property.
But if, just to be clear here, if they don't get the property because they are outbid or the seller chooses another bidder, they get their check back, right?
Oh, yeah. The agent representing the buyer would hold on to it until we had agreed to terms.
Let's move on to listing number 2, which is a more mid-priced home, a little above the median in your area, listed at $449,000, but it went above that.
Yep. So I went to talk to them, and they were thinking right around $425,000, but it was a great opportunity. And I said, I really think that we can stretch it to the $450,000 mark, because I think the person that would pay $425,000 would pay $450,000, and we did, and we received multiple offers and got $465,000 for it.
Are you crazy? That's my comment on that video you just watched. Would I be a buyer and put up $75,000 non-refundable money and pay $75,000 over asking price? Here's what's going to happen. I'm the lender, okay? So unless you want to put a ton of money down, so let's take it as the lender's perspective, and let's take it as the consumer's perspective. Well, let's flip that around. Let's go to the consumer first. The comments that stood out to me in that conversation was, he's giving the buyer the opportunity to buy this, what did he say? Rare product, a house. If I'm buying a $50 million home, that's a rare product, not a standard house with 4 bedrooms, 3 baths, 2-car, 3-car, 4-car garage, and so forth. That's not a rare product. So I don't like that spin. The $75,000 non-refundable. If you lose your job, your spouse passes, something happens, you just blew $75,000. The next piece of the puzzle, how long? Let's say houses, I don't really think we're going to go backwards for a while, but let's say they stagnate. Your house is still probably valued at $725 because all the houses in your neighborhood are valued at that range. As they said, that's what the comps came in. But now you have this white elephant up here that you're stuck in. Okay. Those are my perspectives as the buyer. So if I want this rare opportunity to be blessed to buy that house, and if you feel that way, God bless you, buy it. Me as a normal consumer, I ain't buying. Okay. So now on the lender side, here's what's happening in these cases. When we pull, just because you want to buy that house for $800,000 doesn't mean I'm lending on an $800,000 value. Why? If you listen to the key words in there, the house is comped, meaning all your comparable homes around the area were about $725. So here's what's going to happen in most cases. As a lender, we will finance or lend on the purchase price or the appraised value, whichever is less. So in this case, most likely the house is going to appraise for $725. So that is now your benchmark. Now your down payment is based off of that. So let's say you're putting down 10%, on this in this equation. Okay, you need 10%. So you need 10% of the 720 plus, that's the appraised value, plus all the overage of the amount of money that you paid over the asking price or over the comped value or over the appraised value. We're not going to lend because you want to buy that house at 800, even though everybody's saying the house is worth 725. Now, a year, 6 months, a year or two from now, that house might be worth 800. It's not worth that today. Okay, because they said the comps in the area support 720. So let me go backwards. The house was based on 720 and originally sold for 800. Okay, on our side of the equation, it's probably going to appraise for 720. We're going to base our loan on that. So even if you were doing 100% financing, we're going to base on 720. So you pay 800, you're going to have to pay 75,000 cash over and above all this. Let's say you were wanting to put money down. Okay, which you're going to most likely have to do, say 10%. Again, it's based on the 720 value. So you have to bring in 10% and then the extra $75,000. I hope the math works out. If it doesn't, guys, what my bottom line is, I ain't buying that house. And then the next one, they came back and said you listed it at the customers thought it was worth $425. Many times we don't know what the houses are worth. They said, let's list it for $449. And they were fortunate enough to get $465. Again, it'll probably appraise for $440, $445 range. Anything over and above that, you have to pay cash over and above that, plus your down payment, plus your closing costs. So you're going to be into this thing for $25,000, another 10% down, plus another $5,000 or $6,000 in closing costs. It's nuts, folks. And I'm a mortgage guy. I want people to buy houses. This is how we make money. But I don't want you guys to do stuff out there that's stupid. That's my comment for the day on the housing market. So what I anticipate happening with this is Come September, you're going to have a lot of forbearance programs ending. Forbearance is basically if you're a homeowner now, you can postpone your mortgage payments. In many cases, you could have postponed it for 18 months. They basically all go away in September. So after September, you're going to have people they're going to have to make mortgage payments again. Let's say you can't afford it. Well, what are you going to do? You're probably going to list the house for sale. Let's say, for example, you couldn't afford it 3 months ago. Well, it didn't matter because you didn't have to make mortgage payments because you were under the forbearance agreement, part of the CARES Act. So if you're like, I can't afford it, but I'm not making any mortgage payments, my alternatives are I can sell the house now at a high value, but where am I going to go? I go rent, I got to make a payment. I go buy another house, I got to make a payment. Can I move back in my mom and dad's house? If you can, that might be the idea to go. So that's my perspective on all of this. So now, stop the rant and raving, let's get on to where mortgage rates are today. So basically where I got the information that I just went over is CNBC. Their headlines right now is this: why the real estate market in Raleigh, North Carolina is booming. Guys, it's booming everywhere. Okay, so now people come to me, why? Because we want to figure out where mortgage rates are going. So today we want to focus on this number right here. This is the mortgage-backed securities market. This is the bond that trades on Wall Street that is the biggest component or factor in your mortgage rate. It's not the 10-year Treasury. It's not the S&P. It's not the Federal Reserve. It is this. So what happens is when this mortgage-backed security bond, it's a bond that trades on Wall Street, goes up in price, the yield or your mortgage rate goes down. Okay, so that's how it works. So we love when this is green. My concern coming into this week was the Federal Reserve. Okay, so let me give you some things in perspective. In May, when the Federal Reserve spoke, there was fear of inflation and tapering of their bond buying. Market plunged. Remember, when it goes down, rates are going up. Then we recovered. And then what happened here? The June Fed meeting with the fear of inflation and the tapering threat. Okay. And then I just reported, this week I was monitoring day by day by day. What happened when the Fed spoke this week? Well, the news came out right here. Look at this. It is a complete reversal. So basically the markets right now are saying, you know what, the Fed isn't going to do anything until employment really gets on track. They could give a crap about what's going on with inflation. Okay, good or bad, I don't know. Only time's going to tell. I am in the Federal Reserve side of the equation here. I think we're going to start seeing inflation, tapering off the end of next year. Again, why? Okay, so let's go over my reasons why, and then you can debunk that if you want to try. Forbearance agreement. Part of the CARES Act, they gave homeowners what's called a forbearance, and I explained that just a little bit ago. You can postpone or not make mortgage payments for a year. So what are you doing with that money? For those that are still working, you didn't even have to prove anything, hardship, anything. All you had to do is call your mortgage lender and said, I want to forbear my mortgage payments for the next year because of COVID, and they granted it for you. So you had tons of people that didn't really need it, but they went into the forbearance agreement. That increased their cash on hand, okay? The next thing is student loans. Student loans were also deferred or postponed. You didn't have to make student loan payments. Probably half the country has student loan payments, substantial student loan payments. You don't have to make those payments, okay? And then if you weren't, I'll say this, in the lower income wage bracket, you are probably making more money now than you were before because of the excess stimulus. Now, I know there's millions of people out there that are like, Dan, that doesn't help me. I was making 10 grand a month and now I'm making $2,500. Doesn't pay the bills. I get it. But the majority of people, and this is backed up by studies of where the stimulus money went into either savings or investments. 70% of the last check went into savings or investments. And you can see that as part of the stock market. So those cannot be debunked. Those are studies by Wall Street, studies by other firms, and studies by the government as well. So that's that part of the equation. That's my explanation of a lot of this stuff. So the good news was the markets aren't really caring about anything right now. And they're saying, we're just going to sit back until employment is at full capacity. So that's where we are. We're seeing a nice uptrend right now. Again, the uptrend means the higher we go up, the lower the rates come back. Okay, so I thought we were going to be right in this range right here is where we were going to settle. We're above that right now. I'm looking at being at a 101.8 handle right here, the number, and we're at 101.92. That's fantastic. Okay. And they're beating the yields on the 10-year treasuries. So if you were a bond investor, you can buy 10-year treasuries and get a yield of 1.23, or you can buy in mortgage-backed securities and get a yield of 1.1 or 1.92. Where are you going to put your money? You're going to put your money in here. Okay. The other thing we focus on is what the economy is doing, because economic data also has a role in this whole equation. This is what happened this week. As you can see, the Federal Reserve came out on Wednesday and gave us their news. Then Federal Chairman Powell spoke. It didn't move the markets. That was a huge win for all of us. Okay. Next week's news, what's going to come in? Well, as I said it before, we focus here on, or what the Fed's focusing on right now, is the employment numbers. So this is Bloomberg's economic calendar for next week. And you go through here and you have manufacturing. We don't care about any of these. We don't care on Tuesday any factory orders. What we care about is Wednesday, the ADP non-payroll numbers. The Federal Reserve is going to watch these things, and they want to know what's, are people getting back and going back to work? They want this number to go up and up and up, basically to full employment. And that number is debatable, because what exactly is full employment? We never will have 100% of people working. So the employment rates, we're looking at about 3% or so, and we exceed that right now. So that's the biggest part of the equation for next week, along with the initial jobless claims and continued jobless claims. And we're going to get a lot of that stuff on Thursday and Friday. So that's the news coming out next week. And believe me, these numbers are going to be significant in the employment numbers, and we're going to be watching them steadily. What's happening today? Basically, it's a nice day. It seems like it's crazy and wild, but we're steady and we're up 6. So I have no concerns there. Now on to rates, where rates are right now. What I do is I follow Black Knight, and they're an economic firm, economist firm, and they do a lot of studies, and they study mortgage rates, 30-year mortgage rates throughout the entire country. So what they do is they survey lenders all over the country, and we report back what our rates are. So let's go over where the 30-year rates are today and where they were, and then my expectations of where we're going. So 30-year conforming is right now at 3.02. The jumbo's at 3.05. FHA is 3.16. VA is 2.68. 1-day delta, 7-day delta, 4-week delta. Delta means change. So basically, if you look at this, there's no change in the last day. There's really no change in the last week. And we're about an eighth better than where we were. Let me explain what basis points mean so you figure that part out. A basis point is basically, let's say we'll go with 1 basis point, just to make it simple. 1 basis point equates out to 1/100th. So 0.01. So when you see a 1, a 2, a 4, it's 0.04. It's not going to do anything for rates. Okay, so that's where rates are today. And that is it for today. So I hope you found a lot of value in this channel. If you did, all I ask you to do is give me a thumbs up, subscribe down below, hit the bell every time I post a video. You get an alert. Have a great weekend, guys. God bless. I'll see you Monday.